Good morning. Welcome to the first show of podcast from the Securities Commission Malaysia and BIX Malaysia. So this show is called Brewing Finance Conversations on Bond and Sukuk. We have here our first speaker of the day, or our first speaker of the session, Mr. Woon Khai Jhek, also known as KJ. Don't confuse him with the current famous KJ. He's going to be famous as well, but he's known as KJ and let it be. Yeah, Mr. KJ. So Mr. KJ is the Senior Economist and Head of Economic Research Team from RAM. And welcome aboard. Welcome to this beautiful building of SC.
Yeah, thank you for having me. Yeah.
So perhaps before we start, perhaps you can introduce yourself a bit and what do you do at your organization and a bit of your background. Over to you.
Yeah. So as you mentioned, my name is Khai Jhek. I'm the Senior Economist and Head of Economic Research at RAM Ratings. My friends do call me KJ, but that's only among my friends, so I hope maybe I'll also be famous one day, as you have mentioned. So basically in RAM, our main business is we are a regulated credit rating agency by SC. But for my unit specifically in the economics research, we do cover macroeconomic related trends and developments, and also financial markets, specifically on the bond market. So we do cover things like what you hear usually in the news, like GDP or inflation, and also if you move into like bond market, bond yields, fund flows and all. So all those we do actually also research and cover. Yeah.
All right. So we trust that your views and your opinions are very much important to the reaction and perception of the investors. So let's go straight to our main business. How did we do back in 2023 and the first quarter of the year 2024? So Malaysia's bond market performed in 2023. And what do you think the performance had been, and what will be the underlying, and what was the underlying factor driving these trends?
So for the bond market, I think for full year performance, it has been performing. If you look at just the headline numbers, it did perform actually quite well. Foreign fund inflows actually rebounded in 2023 to about 23.6 billion ringgit, from a net outflow of 9.8 billion in 2022. Other than that, if you look at bond yields as well, it has also fell on the longer end of the curve. I'll go into more details of why later. So largely, if you look at just fund flows, I mean, fund inflows is usually good for the market because there's extra liquidity and all. However, I think if you look at the headline numbers, doesn't really justify or tell you the true story of how volatile and a lot of back and forth that we see in the market. Especially if you look at the early of the year, I think due to change in expectation in terms of when the US Federal Reserve would actually stop raising rates back then, that change in expectation have actually led to quite a lot of fund inflows, at least in the first half of the year. I think if you look at, say, specifically in the first half, we do see quite a lot of net foreign fund inflows from the foreign investors. For the first 7 months of the year, it actually amounted to around 32.4 billion. So it's actually much higher than where we were in terms of the full year number. However, I think sentiment did rapidly change in the second half of the year because of some hawkish messaging from the US Fed that interest rate might actually stay higher for longer than expected. So I think that triggered a lot of negative sentiment and a flight to safety among investors, specifically foreign investors that maybe are a bit iffy or a bit more cautious on where they would want to put their funds into. So that's why I think for the remaining 5 months of the year, we actually charted quite a large amount of outflow from around, I think, starting around September to around December, although there was a one-off fund inflow in November, but that is also due to a one-off rate cut bets among foreign investors. But I think that quickly was quashed by the Federal Reserve, that they insist that due to the sticky inflation in the US, they are not likely to actually start cutting rates as soon back then. Yeah. So that's actually largely what has been driven the fund volatility and just the general weaker sentiment that we see in the market. And I think that has also indirectly led to some weakening in terms of the ringgit against the US dollar purely because of that volatility. There were a lot of flight to safety, and that's why I think ringgit wasn't really performing that well, maybe towards the end of second half of the year. Mm-hmm. Yeah.
So most of the factors that you mentioned is the external factors. So does that mean that we do have a strong fundamental and it's not reflected in our numbers?
I think in terms of fundamentals, I think Malaysia, economic-wise, is actually performing relatively well. Although last year, if you look at, say, GDP growth, we did underperform expectation. I think full-year growth came in around 3.7%, which underperforms Bank Negara's and the MOS expectation of 4%. However, I think a large part of it is due to external factors. Domestic demand continues to drive growth for Malaysia. And I think much of the external demand weakness actually came in towards the second half of the year, because we did start the year actually relatively well. I think first quarter growth, it came in at around 5.6%, which is somewhat higher or close to where we were pre-pandemic. However, for the remaining 3 quarters of the year, real GDP growth, quarterly year-on-year growth, have actually fallen to around that 3% level, which underperforms where we should have been. And that largely, again, as you mentioned, is due to external factors. Export growth actually weakened quite substantially due to weakening in terms of global demand. And that has also indirectly led to weaker exports from Malaysia. I think so far, this is also partly why we do see full-year growth actually underperforming expectations.
So the numbers have been good. So you mentioned about how it corrected, the numbers corrected throughout the year. But how did we compare against our peers, especially within this region?
I think region-wise, I think due to the nature of how most economies in the ASEAN region are, most of us are small and open economy. Although some are more domestic-oriented and some are more export-oriented. I think generally everyone does feel the impact that is actually coming out from the weaker global economy. The slowdown in global economy have actually impacted the export growth and export performance across most of the economies in the region, and that also includes Malaysia as well. Yeah.
So with all that has been said, so how has the investment approach to bonds changed, especially since the onset of the pandemic?
I think if you talk about investment approach to bonds or how the market is actually treating the fixed income market, I think we still have to go back to the US Federal Reserve, because they are actually one of the key drivers or key determining factors of how investors choose to actually allocate their funds. So if we go back, as mentioned earlier, about how the US interest rate expectations and interest rate decisions actually determine investment decisions. So at the start of last year, early 2023, due to the fact that I think a lot of people were expecting maybe the US Federal Reserve to actually stop hiking rates and maybe look into rate cuts last year, which I think didn't really happen. But back then, due to the expectation, bond yields actually fell quite a fair bit due to that change in expectation. And the lower bond yields also means that there is also more demand on that front, because I think a lot of people want to capitalize on the existing available bonds that actually offer a higher coupon rate back then. So that's why there's higher demand. Also, higher demand also means that your price will increase, then your yields also decline. They are inversely related in that sense. That's why we do see a lot more interest if for people that are actually seeking longer term yields. But I think due to the fact that on the second half of the year, there were a lot more volatility, a lot more uncertainties, then there is that shift towards the heavy on the shorter end of the bond yield curve, because they want to avoid the duration risk. Yeah. That's why there is a lot more interest and demand for shorter term bonds in general last year. Yeah.
All right, Mr. KJ. So we have been talking a lot about our forecast and our outlook on the economy, specifically in the bond market space. Let's look at ringgit. So you mentioned earlier, you described what has happened that affect our ringgit performance, and that lead us to where we are today. But what is do you have any insight, outlook on ringgit performance for the year?
So a large part of it has to do, again, with how the interest rate differential will move going into 2024. Because with the talks about how, or the very firm expectation as to when the US Federal Reserve will start to cut interest rates, I think they are most likely going to move ahead with interest rate cuts. So with that actually, when that actually starts to kick in, then we might see increase in demand for the ringgit. And I think in terms of expectation as to when, most analysts or the market is actually pricing in for interest rate cut to actually commence in the second half of the year. So while in ringgit is actually relatively weak at the moment due to still some investor anxiety and weaker investor sentiment, once that dissipates and investment sentiment improve, once the US Federal Reserve starts to cut interest rate, we might see the ringgit appreciate against the dollar in the second half of the year. And I think we have already seen some signs of it already happening in the past when I think investors start to actually price in for interest rate cuts. I'm not sure if you remember last year, there was at one point where the ringgit actually appreciates to 4.2 against the US dollar.
Yeah, good times.
During around February of last year. So a large part of it is due to just that sudden change in sentiment or change in expectations. Everyone at that time thought that the US Federal Reserve will start to cut rates or at least stop hiking rate as aggressively beginning of last year. So that's why the market starts to price in a very aggressive pricing for the exchange rate at that point. But given how things have turned out, you have known that because of the reversion in terms of expectation, the ringgit also quickly depreciated against the dollar for the remainder of 2023. So given what we have learned in the past, given that we know that once sentiment actually really kicks in, we really might see that the ringgit actually appreciates against the US dollar. But also that really subjects to when and how firm and how certain will the Fed actually starts cutting interest rates. Yeah.
We always benchmark our currency against US dollar, but if I can seek for your insights a little bit more, if we can compare ourselves against our peers, Sing for example, how do you think we are moving for the year? Do you think it's going to improve as well?
I think generally speaking, the currencies in this region have also actually depreciated against the dollar throughout most of last year and this year as well. So I think once the US Federal Reserve starts to cut rate, that will also benefit currencies across the region as well. So while I think given interest rate differential maybe in Malaysia and say for example maybe Thailand or even Indonesia might also change, but I wouldn't expect the change to be that significant moving ahead. But I think the only exception really comes from Singapore dollar, because it is of the unique way of how actually Singapore conducts monetary policy. They utilize exchange rate as their policy tool due to the fact that it's actually much easier to control the economy and price level or price pressure from exchange rate because of a large part of their consumption are actually imported. So it's actually a much more effective tool to actually manage the inflationary pressure. So in the past, because of how high inflation, they've decided to strengthen their currency to actually stem this inflationary pressure, which is why, along with the US dollar, Malaysian ringgit has also depreciated quite a fair bit against the Singapore dollar. But that might actually change moving ahead, because I think as inflationary pressure in Singapore has actually gradually subsided, there are talks about how maybe the Monetary Authority of Singapore is actually looking into weakening their exchange rate to sort of normalize it back to a more accommodative level. So we might actually see the ringgit also strengthen against the Singapore dollar once that policy decision actually kicks in moving ahead. Yeah.
Brighter days ahead, hopefully. So if I may refer back to the annual report released by the Securities Commission on the 25th of March. So it was reported that the Malaysian capital market size grew to 3.8 trillion ringgit in 2023. And the bigger portion of it, 2 trillion, was contributed to by the bond and sukuk outstanding, bond and sukuk market. So if I can explain, perhaps I can give you a bit of overview, or I can give you a bit of insight of what was reported. So if we look at bond market alone, since 2020, the size grew from 1.6 trillion to 1.7 to 1.9 in 2022, and back in 2023, last year, it grew to 2 trillion ringgit, just for the bond market size. So I wish to seek for your insights, or perhaps your wise view, whether this is going to maintain moving forward. Are we going to look at the bigger numbers, more than 2 trillion, on the bond market alone? Or do you think it's going to normalize, or there will be a correction, and we are going to look at sub 2 trillion on the bond market?
So in terms of where the bond market is heading, I think it has been growing, like you mentioned, year on year.
Yeah.
Large part of it is due to just pure expansion or pure increase in size in terms of the economy. So as the economy increases in size, there is also increased demand for financing, because financing is typically what will help to also drive economic growth. So we do see that in terms of where the fund market size is actually going, this somewhat also correlates with where the economy is also heading. So as we expect economic growth to continue to on a steady growth path, we might see that the bond market size also grow accordingly. Yeah. Although I think there will be some years where there will be some anomaly due to some unexpected factors, but I think on the longer term trend, we should expect the size to also grow accordingly as the economy also grows due to an increase in terms of financing demand.
So moving on to the second part, so 2024, the market outlook and where we are going from now onwards. So as we look ahead to 2024, what are the key trends or developments that investors should keep an eye in the bond market? And what are the key factors shaping the bond market's trajectory this year?
So again, similar to what has been affecting last year, it will likely also continue this year, specifically coming from there's talks about normalization in terms of reversing of the aggressive interest rate increases and monetary policy tightening last year, heading into this year, partly because of how inflationary pressure are expected to actually moderate coming into 2024. So a lot of the central banks around the world are thinking of scaling back in terms of their interest rate levels, and that will also determine or affect how the market actually positions their funds going into 2024 as well. So definitely one thing that everyone has to look out for is when would the US Federal Reserve actually start to cut rates. There are already quite a fair bit of talks as to that the US Federal Reserve will likely start to cut interest rate this year. I think the Federal Reserve most recent forecast or estimates have put in at about a 325 basis points cut for 2024. However, I think the key unknown at the moment is definitely the pace and the timing of when the US Federal Reserve will actually start cutting rates. So when it actually starts cut rates, we might see the interest rate differential between, say, for example, Malaysia and the US actually narrow further. Okay. And that will also increase the attractiveness of the Malaysian market among foreign investors. Then in turn, it also, as what we discussed earlier about the ringgit and fund flows, the stronger attractiveness and higher demand will also encourage foreign fund inflows and also somewhat support the ringgit against the US dollar. Yeah.
So if I can be a bit naughty on that, so we were the victim when the Fed raised hike their rate in the past. So what do you think is going to happen? You mentioned that it's going to be narrowed down. So are we going to be the beneficiary in the future? And do you think that are we going to increase, decrease, or maintain our rate at the moment?
So regarding whether are we the victim, I wouldn't say we are the victim. You are just an unintended consequences of their domestic policy consideration, because I think all central banks conduct policy decisions based on their domestic economic conditions. So including for Malaysia as well, we also conduct our domestic policy based on the current domestic conditions. So there are calls about, say, why didn't the Bank Negara raise even more interest rates to actually defend the ringgit against the dollar. However, we also have to take note of the fact that there is also trade-offs or costs to the economy if we do also engage in as aggressive sort of monetary policy tightening compared to the US. So we might see higher mortgage rates, higher cost of doing business, higher cost of financing, and that will also stifle economic growth, which is what we do not want to happen. In terms of, say, whether what would Malaysia actually do and how would Malaysia actually perform, so definitely I think once the US actually decides to actually start cutting rates, we might see some returns of fund inflows, and Malaysia would be one of the beneficiaries, I would say, because of the fact that our economy is relatively stable, so there's actually not much need for the Bank Negara to actually step in to further tweak or adjust the OPR this year. Our current expectation is that for the OPR to actually stay unchanged at 3% until the end of this year. Mm-hmm. So with the interest rate not expected to change, while I think countries around the world, while they actually start to normalize or scale back in terms of their aggressiveness in terms of their interest rate levels, we should also see that our interest rate differential or interest rate advantage should tilt towards Malaysia, and that will also encourage more foreign fund inflows and foreign attention or foreign appetite for the Malaysian market.
So we are hoping for a brighter future then moving forward. But if you can narrow down, what will be the assets most likely to be invested by, especially by the foreign investors? Is it going to be bond? Is it going to be equities? Or perhaps is it going to be some alternative investment assets in Malaysia?
For Malaysia, a large part of the foreign fund inflows actually heads towards the bond market. So compared to, say, equity and bond market, actually a lot of the foreign investors or foreign fund flows actually can be attributed to the bond market. So I wouldn't expect that to actually change substantially moving ahead. There is a lot of fund flows and fund attention towards the bond market, specifically given how our bond market is actually relatively large in this region. So with the relatively established infrastructure and a lot of attention towards this market, definitely there will be a lot of foreign investor interest going into, say, the government bond space as well. Historically speaking, a large part of the foreign holdings in Malaysia is also concentrated in the government bond space, particularly in the MGS space as well. So once the interest rate differential or the investment decision actually tilts in favor towards Malaysian bonds, we might see also further interest and further foreign net buying into the MGS space as well in 2024.
If I can understand a bit more on that, why are the investors skewed or more, they are keen towards the government bond? Is our corporate bonds not attractive enough? What will be the factors that affect their decisions between these two, between the government bonds and the corporate bonds?
In terms of attractiveness, I believe that maybe a lot of the investors, a lot of them are actually fund houses. Although there are different type of investors, I think a lot of them actually are benchmarked against some of the key indexes, and a lot of them follow the fact that they need to meet a certain requirement or a certain proportion in terms of their holdings for Malaysian government bonds. So maybe that's why we do see a lot more interest and appetite for Malaysian government bonds. Yeah.
So do we know, as compared to individual high net worth individuals, or perhaps certain levels, small portions of retail investors, as compared to the institutional investors like the fund management companies, even GLICs for that matter, or even GLCs, do we know do you know if they have similar factors or similar indication for them to decide whether they want to go into which kind of bonds for them to invest in?
I think it really depends on their investment strategy as well as the type of investors they are. So I think historically speaking, if you look at just the local institutional investor pool, we have a lot of fund houses, say big investors like your EPF, your Co-ops, your PNB. They have different investment mandates, and naturally they also have different investment appetites. So I think, for example, if you look at like EPF, they are a bit more investment towards retirement savings. So some of their strategy, I'm just guessing that it could potentially due to the fact that they want to match their liability in terms of their pension or their defined contribution sort of payment. So they might have a mix of, say, bonds investments as well as equity investments. But say, for example, institutional investors like insurance companies, they are a bit more conservative due to the nature of their business. So in terms of, like, say, for example, meeting their asset liability matching, they might lean towards something more safer kind of investments. So it really depends on the type of investors that we are talking about and their investment strategies. But you did mention about retail investors. But I think for Malaysia, the retail investment in terms of, for example, into the bond market is actually relatively undeveloped. There's very limited retail participation in the bond market in Malaysia. And I think I also believe that SE is also trying very hard to encourage retail investors. But I think for now, it remains a very small portion, and it's only very limited to high net worth individuals. So the amount of contribution or activity on that space isn't really that much. Yeah.
That's true. So SE is actually doing a lot of initiative programs to promote retail bonds, and hopefully we can see high numbers in this space. So if you may allow me to dig in further within this fixed income market, do you see any difference in terms of demand comparing bonds and Sukuk?
I think domestically speaking, due to a lot of initiative as well as encouragement or promotion of the Sukuk market, Actually, currently, Sukuk market is actually quite large in Malaysia. And I think investors do actually treat both conventional as well as Sukuk quite equally. And I think because of some preference among some of the companies to issue Sukuk, in the corporate bond space, we do see quite a lot of Sukuk supply in the market as well. And I think investors have also been taking up that new supply of Sukuk. And I think definitely demand wouldn't be, I wouldn't say, unlike maybe say 10 years ago, I think the Sukuk market is definitely much more developed now. And I think investment, at least among the local community, have been quite accepting of this new, I guess relatively new speaking, Sukuk investment instruments in the market. But I think the same couldn't really be said for, say, foreign investors. Because as mentioned earlier about how foreign investors typically do invest mostly in government bonds. But we do have MGS, which is conventional government bonds, and as well as GII, which is the Islamic government bonds. However, in that space, if you look at the share or investment holdings among foreign investors typically do prefer MGS as opposed to GII. So the investment holdings of GII is actually relatively small compared to MGS. And maybe more efforts could be actually put into to encourage or to educate foreign investors that maybe they should also consider investing more into the GII space as well. Yeah.
So you mentioned at your earlier part that investors perceive both bond and Sukuk equally, so they don't really see much difference. So I suppose because as long as they can generate you enough yield that meet your investment expectation and your investment objective, that's good enough for them. What about the companies? What about the issuers? From your observation, why do you think that some companies, especially in our local market or domestic market, why a lot more tractions are given towards Sukuk as compared to bond? Is there any reason for that? Why companies choose to go for Sukuk issuances compared to bond?
So I think, like you mentioned, like investors doesn't really differentiate that much as long as they meet the rate of return that they require. Plus, also I think for some companies there's also a mandate to actually invest in certain proportion of Islamic securities. That's why there's also increase in demand recently for Sukuk bonds and so on. But I think for issuers, a large part of why there has been a very fast-paced growth in terms of the Sukuk issuance is also due to government policy encouragement. I think in the past there used to be some form of incentives as well as maybe some tax breaks in terms of issuing Sukuk, which is why I think some corporates have actually gone down the Sukuk route. But I think recently it's also more due to increased demand. There are some demands for Sukuk instruments and Sukuk investments. That's why I think corporates has also been meeting that sort of demand, because whenever they issue a bond, they also want to meet a very healthy demand for their issuances. So to meet what the market wants at the moment, some corporate has also gone down the Sukuk route at the moment. Yeah.
That's good. So another thing about Sukuk that I want to understand, and I think everyone would like to hear the story as well. So historically, I think for the part in the 10 years ago, at least 10 years ago, and even older than that, Sukuk, Malaysia is seen as the champion of Sukuk, a global champion of Sukuk. So we had been the main, the biggest issuers in the Sukuk space. But I think now we are losing the fight. Some other countries like Saudi, I think if I'm not mistaken, even other MENA countries are actually catching up. Why are we heading towards this direction? Don't we have enough strength in the space? Are we not attractive enough in terms of Sukuk?
I think personally, I feel that the growing Sukuk market is also a signal or indication that I think globally there is increasing acceptance of Islamic securities, which is why I think there is also increased development in the Middle Eastern countries, as well as you mentioned, the MENA region. But I think for Malaysia specifically, we do have our own investor base and investor pool. So we have also been rapidly growing our Sukuk market. So I wouldn't really compare too much as to how Malaysia is actually losing out to that region, because I think both regions have their own source of supply of instruments as well as source of demand in terms of investors. So I think so far we have been growing quite rapidly, and I think we shouldn't really compare too much as to how the other regions are doing, because we do have our own market per se. Yeah.
So we can see at the moment that the Malaysian government have been trying to source a lot of revenues, income for the countries through many means. So one of the the latest things that they have been introduced is the introduction of the service tax, the SST. So what do you think of the service tax hike, and how will that impact the headline inflation? Will there be any spillover into OPR decision?
So for the service tax, I think, like you mentioned, it's definitely one of the ways that the government is actually looking into to diversify and broaden their tax base.
Yeah.
So rather than employing a new tax measure, they decided to capitalize on an existing tax system, which is the SST system. Mm-hmm. And specifically this round, they are expanding the scope of the service tax coverage, mm-hmm, as well as the service tax rate. I think, but undoubtedly, due to the increase in terms of revenue, we will also generate an unintended or a direct impact into inflation, mm-hmm, due to some of its coverage or just the pure increase in prices for some of the services that is offered to the economy. Mm-hmm. So far we have crunched some numbers, and our rough estimate at the moment is that for the service tax to have a direct impact to headline inflation of about 0.3 to 0.4 percentage points. Mm-hmm. So we do expect some increase in terms of prices, and indirectly also mean a higher rate of inflation moving ahead. However, the direct impacts are unlikely to be that significant at only about 0.3 to 0.4 percentage points. So in terms of how it would actually impact OPR, that will really depend on whether would there be second round effects going into other prices, and would it be more pervasive than expected. So if there are sources of indication where price increases are more pervasive than expected, and there are very strong signals that we are experiencing some form of demand pull inflation, then we might see the Bank Negara actually step in to raise the OPR to stem some of these price effects. However, if it's purely due to supply side kind of cost pressures, purely maybe just a one round effect from the higher tax rate, then we do not expect Bank Negara to actually step in to stem this supply or cost push sort of price increases.
So what are your expectations in terms of bond market issuance and or supply for the year?
So for bond market issuance, if you look at, say, for example, the corporate bond market, we are projecting that issuance to remain healthy based on the pipeline that we have seen so far, and we have pending issuance projection of 110 to 120 billion ringgit for 2024, compared to the 118.3 billion that we saw last year. Mm-hmm. So a large part of it is going to be driven by private refinancing initiatives, just among the corporates, as well as the continued infrastructure financing needs, given that we do have ongoing pipeline in terms of mega projects. Mm-hmm. And also the typical financial institution capital augmentation plans as well. Mm-hmm. Because historically speaking, FI has been one of the largest sectors in terms of bond supply, so we do not expect that to really change substantially moving into this year. In terms of the government bond space, we are projecting MGS and GI issuance to actually moderate slightly to around 170 to 180 billion, compared to the 190.9 billion that we saw last year. So a large part of it is due to just a pure lower deficit financing needs, given the lower fiscal deficit that the government is actually budgeting this year. So the lower needs will also mean slightly lower MGS and GI issuance supply for 2024.
So if I can sum that up, so we are going to see rather stagnant comparing 2023 and 2024 numbers. So number of issuances will not differ much compared to last year.
I think for example, if you just look at the government bond space, I think the issuance is bound to come down because due to a very high base, because over the last few years there are extraordinary spending from COVID-related
There will
measures.
be a correction then, in a way.
So in a way, this is more of a normalization that we are seeing in terms of government bond issuances, because the last few years is just pure high base in terms of extra unexpected spending from, say, COVID-related support measures. For the corporate bond space, I think typically it has always been hovering around this range. So barring any unintended changes or unexpected changes, we wouldn't see a very sharp increase in terms of corporate bond issues as well. So hence we do have a relatively healthy and moderate issuance level of 110 to 120 billion projection that we have at the moment.
So talking about issuances, we have seen in the past couple of years, the bond issuances have always been bigger as compared to the equity market. So do you think this trend will be maintained or do you see liquidity issuances will be higher for this year?
I think in terms of the bond market space, it has always been quite large because of how I think we do have quite a large focus on growing this fixed income market, which is why I think in terms of, say, investor diversity as well as investor base, typically fixed income market is a bit more vibrant compared to the equity market. So I would think that maybe perhaps fixed income market will continue to the main driver or the bulk of where the financial market activity would be in for Malaysia, at least in the short term.
Okay, so I think we are approaching the end of our session. But before that, given the evolving economic landscape, what is the outlook for the Malaysian economy and bond market? Will the prospect this year be better than in 2023? And if I can stretch that a little bit more, from where we are at the moment, do you think 2025, in fact, is going to be good as well compared to 2024 and 2023?
So if you talk about the outlook for this year, definitely we have to start with the economy. So if you look at, say, for example, if you look at GDP growth, we are projecting GDP growth to actually improve in 2024. Currently, we have penned in GDP growth forecast of 4.5% to 5.5% for 2024, compared to, as mentioned earlier, the 3.7% that we have for last year. So we are expecting that economy will improve on the back of improvement in terms of external demand, because last year, a large part of what has been dragging down growth is the weakness in the global economy. However, we are seeing signs that external economy or external demand is actually starting to pick up. For example, if you look at the most recent export numbers, while it did contract in the fourth quarter, but at least the first 2 months of the year, we are seeing export growth actually surfacing above the 3% mark. So we are seeing a positive growth, and we do expect that momentum to actually continue towards the rest of the year. And if you look at all the other leading indicators as well, there are also signs that I think external demand will continue to pick up moving ahead. And if you look at, say, for example, the main driver for the export growth in Malaysia, a large part of our exports are actually in the E&E space, semiconductor space, which contributes to roughly close to 40% of our overall merchandise exports. The international agencies are actually projecting an upcycle in terms of the E&E space. So Malaysia is also expected to benefit from this upcycle, and that will also contribute to a higher export growth for Malaysia in 2024. If you look at other leading indicators as well, in terms of the E&E space, typically countries like Taiwan and South Korea do lead Malaysia's E&E sector. So we are seeing quite a sharp rebound in terms of E&E exports or E&E activity across those two countries. So while Malaysia's export growth are still slow at the moment, given that the good signs that we are seeing from those two countries, Malaysia should also improve accordingly down the road, maybe in about half a year or 6 months or so. Other than that, I think in terms of the economy, we will continue to be driven by domestic demand due to the healthy labour market at the moment. So with that not expected to change much, domestic demand will continue to drive or underline the overall growth. Moving on to the bond market, I think bond market outlook as well is looking quite good, given some of the factors that will likely turn favourable for us in 2024. The key thing is definitely coming back again to the US Federal Reserve, with them actually expecting to also start cutting rates. That will boost investor sentiment, and generally we might see that the risk aversion as well as the flight to safety sentiment that we saw last year likely dissipate, and we might see a more normalized financial market activity and investment fund flows going into Malaysia this year. So far we are expecting fund inflows to continue to chart a net fund inflow or net purchasing among foreign investors in 2024. So that is also on the back of the fact that with investment sentiment expected to improve, we might see a more return or a higher investment participation among foreign investors into Malaysia in 2024 as well.
We have definitely learned so much from you, Mr. KJ. I think that is going to wrap up our session for the day. We definitely hope that you will be available in the future so that we can learn more from you, especially towards Q4 or maybe next year, so that we can learn more and understand your insights so that we can make more informed decision informed investment decision moving forward. So thank you so much for spending your precious morning with us in the SC, and hope to see you again.
Yeah, thank you for having me. Hope to see you again.